Welcome to my channel. This channel is created for educational purposes only, dedicated to people who want to learn how to trade. Either you want to trade stocks, crypto, commodities, or Forex, you will find high quality educational material. Either you are beginner, advanced, or intermediate trader. For viewers that want to see more action and how we apply the theory in real trades, you can visit our live channel. Here we are trading our live accounts and applying the theory, proving that it can be done while all trading profits goes to our subs. However, as beginners, I do not recommend starting with any real money. Trading is very risky and challenging, but risk comes always with a reward. You will find 50 videos to understand the theory, 12 sections. Each section is a playlist consists of several videos. I do not recommend skipping chapters and trying to take lessons from the beginning. We are using verified sources to provide the most accurate information. This is an educational channel, and you will always trade with demos to avoid the risk. Making profits in the market is not the easy passive income you have in mind. The entire material is equivalent and similar with most trading courses that you will find out there. The material is totally free, and you don't have to pay any guru to learn the basics or waste thousands of dollars. So if you want to support us, subscribe, like, and leave a comment for the YouTube algorithm. Thank you very much, and trade safe. The US dollar holds a unique position in the world of finance and trade, serving as a cornerstone of the global economy. We have explained several times in our series the importance of the USD, but an entire episode is just the minimum to cover the basics. Its status as the primary international reserve currency, medium of exchange, and the unit of account for a vast range of transactions has far-reaching implications for governments, businesses, and individuals. In this episode, we will learn the key aspect of the dollar's global role and explore the factors that contribute to its enduring appeal. The origin of the US dollar's global dominance can be traced back to 1944, the well-known Bretton Woods Conference, which aimed to establish a new monetary system to promote international trade and economic stability after World War II. History is written by winners. After the war, as the United States controlled two-thirds of the world's gold reserves at the time, the US dollar became the anchor currency for the Bretton Woods system. Uncle Roger was basically the greedy leprechaun, hoarding all the world's gold in his pot, US own pot of gold. Consequently, countries pegged their currencies to the dollar, which was itself convertible to gold, making it the primary medium of exchange for international payments. As the world needed a strong and stable empire, the US took the throne with zero competition. But why the dollar remained so popular in the post-Bretton Woods era? Although the Bretton Woods system collapsed in the 1970s, the US dollar retained its status as the world's premier currency. This enduring appeal can be attributed to several factors. Economic stability. The Federal Reserve's effort to control inflation have contributed to the dollar stability, making it an attractive store of value and medium of exchange. Network effects. The widespread use of the dollar and international transaction has created a self-reinforcing cycle, with more individuals and businesses choosing to use the currency because of its widespread acceptance. Size and openness of US financial markets. No other market comes even close. The depth and liquidity of US financial markets enable large transactions that smaller markets might struggle to accommodate, further enhancing the dollar's attractiveness. At the end of the day, people want to keep dollar assets because the economic, political, and institutional fundamentals of the United States provide confidence and credibility. Global reserve currency of the most critical aspects of the US dollar's global role is its function as a reserve currency. A reserve currency is a currency held by central banks in significant quantities. It is widely used to conduct international trade and financial transactions, eliminating the cost of settling transactions involving different currencies. Central banks around the world hold a significant portion of their foreign exchange reserves in dollars, which they use to stabilize their own currencies, finance international trade, and provide a caution against economic shocks. Today, central banks hold hold above 60% of their foreign exchange reserves in US dollars. Even though the dollar's share of central banks' foreign exchange reserve has gone down over the years, it's still almost twice as much as euro, yen, pound, and the Chinese yuan combined, which is the same as it was a decade ago. The euro, which is the closest rival for the role of world currency, makes up to 20% of central banks' reserves. And while the stability of the European Union is doubtful, I'm predicting that the euro won't be able to match the stability, power, and influence of the USD. The dollar's stability and widespread acceptance make it an ideal choice for this purpose. The US dollar also plays a crucial role in global commodities market, as many commodities such as oil and gold are priced in dollars. The pricing mechanism simplifies international trade by providing a common benchmark and reducing the need of multiple currency conversions. It also underscores the close relationship between the dollar's value and commodities prices, with fluctuations in the currency strength often impact the cost of raw materials and finished goods. The global role has significant implication for international trade and finance. Most currency are only used within their own country or in cross-border transactions that directly involve the currency's issuer. However, the dollar is widely used for funding, pricing, trade invoicing and settlement, and cross-border borrowing and loans, even when the US is not involved. Its use as medium of exchange for cross-border transactions reduces currency risks and facilitates the flow of goods and services between countries. Additionally, the dollar's prominence in global finance makes it a key funding currency for governments, businesses, and individuals seeking to access international capital markets. About half of international trade is invoiced in dollars, and about half of international loans and global debt securities are denominated in dollars. As a safe haven currency, the dollar is the preferred currency for investors during major economic crises. For example, during the global financial crisis in 2008 and 2009, and the economic chaos caused by the COVID-19 pandemic in 2020, investors rushed to buy the US dollar, dash for cash, because they thought the dollar would keep its value. Rumors of the dollar's death are way overblown. The dollar's global role benefits the United States in several ways. First, it lowers borrowing costs, enabling the US government to finance budget deficits more affordably. Second, it increases the purchasing power of the Americans by strengthening the dollar's value, allowing them to buy more goods and services from other countries. The advantage comes with a downside. A stronger dollar makes American exports more expensive, potentially leading to job losses in export-related industries. Lastly, the widespread use of the dollar in international trade grants in the United States diplomatic leverage, enabling it to impose financial sanctions on adversaries. The US dollar has persisted as the world's main reserve currency for the past 80 years, even though there have been a lot of big changes, such as the end of fixed exchange rates, trade and financial globalization, technological progress, and changes in geopolitics. While the US dollar global role is currently secure, the US dollar's dominance may not be permanent. Factors such as uncontrolled inflation, a decline in the US share of the global economy and trade, excessive debt, or overuse of financial sanctions could undermine the dollar's desirability. As the global economic landscape evolves, the dollar's dominance may be tested, with potential implications for trade, finance, and geopolitics. De-dollarization or de-dollarization is the process of reducing the reliance of the US dollar as a reserve currency, a medium of exchange and a unit of account in the global economy. Particular attention is paid to China's rise in the global economy and digital currencies such as Bitcoin. Regarding China, a recent example is the use of Chinese yuan to pay the crude oil transactions, allowing countries to buy and sell oil without involving the US dollars. This is known as Petro Yuan, which is similar to the petrodollars that were created in the 1970s when the Saudi Arabia and other oil exporting countries agreed to price their products in US dollars. If another currency or group of currencies were to replace the US dollar as the world's dominant medium of exchange, the United States would lose the benefits it currently enjoys, while the countries with the new leading currency would stand to gain. That said, when the pound lost its power, another currency was waiting in the wings to take its place. If you have traded stocks, you're probably familiar with various indexes like the Dow Jones Industrial Average, Nasdaq Composite Index, and S&P. We have done a separate episode for the S&P and you can find in the description below. Similarly, for currency traders, there is the US Dollar Index, the USDX, technically known as the ICE US Dollar Index or DXY. The US Dollar Index is a geometric weighted average of a basket of foreign currencies relative to the US dollar. It provides a general indication of the dollar's value compared to other major world currencies. The index consists of 6 foreign currencies: the euro, the JPY, British pound, the Canadian dollar, Swedish krona, and Swiss franc. These currencies represent 24 countries in total, with the euro being the official currency of most European Union member states. The USDX is an essential tool for measuring the strength of the US dollar in the global economy. It can be traded as future contracts, DX, on the Intercontinental Exchange, ICE, and it's also available in other financial instruments like ETFs, CFDs, and options. The US index is trademarked and owned by the ICE Futures US INC, a part of the International Exchange Group, ICE. ICE is a global exchange, financial data, and technology company that operates multiple markets and services across various assets classes, including the New York Stock Exchange. The components of the USDX are assigned different weights to ensure fairness in calculating the index, with the euro holding the largest weight due to its representation of multiple European Union countries. As we said, the USDX is heavily influenced by the euro's performance, leading some traders to call it the anti-euro index. The index is calculated in real time, approximately every 15 seconds, reflecting interest rates differentials between the currencies in the basket of the US dollar. There are no regular adjustments or rebalancing of the USDX, except of the one-time adjustment when the euro was introduced in the common currency for the European Union. Real-time prices for the ICE US dollar index are available through market data vendors and ICE's subscription services. Delayed prices can be found on various financial websites. Overall, the USDX is a crucial benchmark for assessing the international value of the US dollar and is closely followed by currency traders worldwide. Just like any currency pair, the US dollar index also has its own chart. The index is being calculated 24 hours a day, 5 days a week. The US dollar index is a measurement of the dollar's general value relative to a base of 100. Sounds a bit confusing, right? Well, that's why we are here. If the index goes from 100 to 110, it means that it became stronger by 10% related to the basket of currencies. If the index drops to 90, it means it's 10% weaker related to other basket currencies. The US index consists of 6 major currencies, as we said: Euro, JPY, GBP, Canadian, Swedish krona, and Swiss franc. Each currency in the index is assigned a specific weight which reflects its importance in international trade and financial markets. The weight of each currency is determined based on their share in international trade. For the euro, it's 57%, for the JPY, it's almost 14%, for the GBP, it's 12%, for the Canadian, it's 9.1%, for the Swedish krona, it's 4.2%, and for the CHF is 3.6. To calculate the DXY, we calculate the contribution of each currency to the USD by raising their exchange rates to the power of their respective weights. The contribution of euro, contribution of JPY, the contribution of GBP, the contribution of the Canadian, the contribution of SEK, the contribution of CHF. Finally, we calculate the DXY by multiplying the contribution of each currency by their respective weights and then multiplying the result by the base value of 100. Again, you don't have to do all the calculations, but keep in mind the important information. The euro, the JPY, and the GBP is more than 80% of the basket. So these 3 currencies are the most important and significantly affect the value of the DXY. I am sure you are curious about how to utilize the USDX in the Forex trading arsenal. Let me break it down for you. The DXY is an essential tool for understanding the relative strength of the US dollar, and it can be quite handy when trading currency pairs involving the greenback. Most widely traded currency pairs such as Euro USD, GBP USD, USD CHF, USD GPY, and USD Canadian include the US dollar. If you trade any of these pairs, the DXY can be a valuable asset. Even if you don't trade them, the DXY still offers insights into the dollar strengths on a global scale. In the Forex world, the DXY serves as an indicator of the US dollar overall strength. With the Eurozone accounting for over 50% of the index, Euro-USD tends to have an inverse relationship with the USDX. When one goes up, the other usually goes down, creating a mirror-like pattern in their trend lines. Many Forex traders monitor the DXY as an indicator for the Euro-USD movements. Significant shifts in the DXY are likely to influence currency traders' reaction. Spot USD pairs breakouts will often lead to similar breakout movements in the USDX. In simple words, the USDX is a key indicator for determining the direction of the USD in the Forex market. It's crucial to consider the position of the USD in the pair you are trading. If the USD is the base currency, both the USD and the currency pair should move in the same direction. Conversely, if USD is the quote currency, the USDX and the currency pair should move in opposite directions. Always keep these two simple tips in mind, and the USDX will become a valuable tool in your Forex trading kit. It will help you better understand the strength and direction of the US dollar in relation to other major currencies in the market. There is another kind of US dollar index, known as the trade-weighted US dollar index. The index created by the Federal Reserve is widely used by economists and currency analysts. You can find it on the Federal Reserve Economic Data FRED website. While the website might not win any beauty contest, it's absolutely a valuable resource. The trade-weighted US dollar index, also called the broad index, measures the value of the US dollar compared to other foreign currencies. Unlike the privately owned ICE US dollar index, it uses a more extensive range of currencies and updates the weights yearly. The Federal Reserve aimed to create an index that accurately reflects the dollar's value based on the competitiveness of US goods compared to those from other countries. It was introduced in 1998 to keep track of US trade more effectively. The Federal Reserve Bank of St. Louis provides weighted averages of the US dollar foreign exchange value against a broad group of major US trading partners. The index current weighting is as follows: for the Eurozone, China, Canada, Mexico, Japan, United Kingdom, Korea, Taiwan, Singapore, Brazil, and several other countries. The main difference between the USDX and the trade-weighted US dollar index lies in the basket of currencies used in their relative weights. The trade-weighted index includes countries from all over the world, providing a more comprehensive reflection of the US dollar's value globally. The weights are based on annual trade data, and you can find them at the Federal Reserve website. For historical data, just visit their summary page. The trade-weighted US dollar index is an essential tool for understanding the US dollar strength in the context of global trade, making it a valuable resource, especially for us. The Bloomberg Dollar Spot Index is designed to monitor the performance of a basket of 10 global currencies against the US dollar. Unlike other dollar indexes such as the DXY, the Bloomberg Dollar Spot Index offers a more diverse and dynamic representation of the US dollar strength. The composition of the Bloomberg Dollar Spot Index is updated annually and carefully selected to represent currencies that hold significant importance in global trade and liquidity. The index base level is set to 1000 starting from December 31, 2004. The BBTXY takes into account each currency's share of international trade and affects liquidity to determine its weight in the basket. This ensures a comprehensive and relevant representation of the US dollar's performance against a range of currencies that have significant trading ties with the US. A major distinction between Bloomberg Dollar Spot Index and the widely used IC Dollar Index (DXY) lies in their respective compositions. Bloomberg Dollar Spot Index is more representative and diversified, considering not only major currencies like the euro but also incorporating emerging markets such as the Indian rupee, the Korean won, Mexican peso, the Chinese renminbi. These emerging market currencies plays crucial role as trading partners of the US, adding depth and relevance to the index. Furthermore, the BBTXY stands out for its dynamic nature. Annual rebalancing process ensure that the index accurately captures the changing state of currency markets. This approach allows the index to include important currencies based on their liquidity and trading volumes, making it more flexible and a responsible measure of the US dollar strength. In conclusion, the Bloomberg Dollar Spot Index offers a more comprehensive, diversified and dynamic measure of the US dollar performance against global currencies. Its careful selection and annual rebalancing make it a valuable tool for tracking the US dollar strength in the ever-changing currency markets. The dollar smile theory is a fascinating concept that explains the behavior of the US dollar in different economic scenarios. Have you ever wondered why the US dollar sometimes strengthens both in times of economic boom and during tough times? The dollar smiley theory sheds light on the phenomenon. Imagine there are two types of US dollar: the domestic dollar, linked to the US economy, and the international dollar, used for global trade and safe haven investments like the US government bonds. According to Stephen Jen, the mastermind behind the dollar smiley theory, the US dollar tends to strengthen against other currencies in two main scenarios. First, when the US economy outperforms the rest of the world, investors flock of the safe haven US dollar and Japanese yen, causing it to appreciate. Second, during times of global financial turmoil, when a risk aversion is high, investors rush to buy US treasuries, driving up the demand for US dollars. The theory can be illustrated with three scenarios. The USD strengthens due to risk aversion. In times of market panic, investors seek safety in the US dollar and Japanese yen, boosting their demand and appreciation. Scenario number two, USD weakens to new low due to weak economy. If the US economy performs poorly compared to other countries, investors may prefer stronger economic currencies, leading to decline in the US dollar value. And scenario number three, USD strengthens due to economic growth. As the US economy shows signs of recovery and stronger GDP growth, optimism grows, leading to increased demand for the US dollar. The dollar smiley theory is crucial for understanding the US dollar behavior in global markets. It helps investors to understand the relative strength of the US economy against other countries and make informed decisions based on economic cycles. A strong US dollar has pros and cons. It makes traveling abroad cheaper for Americans, but increases expenses for foreign tourists visiting the US. Importing goods into the US becomes cheaper, benefiting American consumers, while non-US consumers face higher costs for US goods. Multinational corporations may experience profit declines when exchanging revenue from local currencies into US dollars. Ultimately, keeping a close eye in the dollar smiley theory helps navigate the dynamic landscape of global currencies and make strategic decisions in the Forex market that eventually will help you to make more informed trading decisions. Thanks for watching. You know that we need your comments, subscriptions and likes to make more content. Go back, repeat the chapters you are not sure, and you will find your name in the Arintra supporters list. Help us to launch it.